Hey guys, it's Jeff Trapp here with the Jeff Trapp Podcast. I'm so glad that you've decided to listen. Today, we've got an awesome episode, and I want to talk to you about something that I think is super important, and that's paying yourself from your business. You go into business and you start a business because you want to make more money. And, one of the key elements of that is being able to pay yourself so that you can pay your bills, save for retirement, save for that vacation that you want to take, your kids' college education, and all those things. But there are certain rules that you must follow when you have a business in terms of paying yourself. And it varies depending on the entity structure you set up. So today I want to talk about the pros and cons of each entity structure on how to pay yourself. But first, what I want to tell you is that if you have a business, you want to make sure that you have a separate business checking account to run your business with for your operating expenses. You want to make sure that it's not commingled with a personal account. Now, if you have commingled accounts right now, you can go down to the bank if you're a sole proprietorship and get a business checking account in your social security number. If you have another business entity, C corporation, S corporation, partnership, you can take down your articles of organization and your EIN number that you got from the IRS down to the bank and get that account established, because this is super, super important. If your assets are commingled, the business and the personal accounts, the IRS can actually disallow those expenses if you are audited. And ouch, that wouldn't be great for your tax bill. So let's dive right into it. So the first easiest entity type is the sole proprietorship. How do you pay yourself from a sole proprietorship, a single member LLC, perhaps? So you don't technically pay yourself a salary. And if you're paying yourself your salary, you shouldn't do that, because this income that you receive from your business is actually subject to self-employment tax, and you're already paying payroll taxes. So you don't need a W-2 and need to report that income again on your tax return. So how you'll pay yourself from your sole proprietorship is through what they call an owner draw or distribution. So this would be an online transfer, or perhaps you will write a check to your personal checking account or personal savings account for the money that you earn in that business, because you're taxed on your business profits, regardless of how much money you actually withdraw from the business. Now, the next entity type that I want to talk about is the C corporation. Now, with a C corporation, you can pay yourself a few different ways. First, you can be an employee of the company and draw a W-2 salary. It's subject to payroll taxes, and the corporation can deduct those payroll taxes that you receive as a business expense. However, profits made by the corporation are also taxed at the corporate level. So the profitability of the business is taxed at 21%. And then you could take dividends from those profits if you'd like, and that's taxed at your personal level, but it's also leads to double taxation because you're taxed at the corporate level and then again at the personal level. So you can't take those owner draws or distributions from a C corporation. Now, if you have a savvy tax advisor or tax strategist, you might be able to take loans from the C corporation to offset this double taxation. But there are very, very strict rules that you must follow when doing that. Now, the next entity type I want to talk about is an S corporation. This is a very popular entity type. If you have a business that makes probably under $500,000, maybe under $1 million, you may have an S corporation. So an S corporation isn't subject to self-employment tax. And so it's a very popular entity type, but the IRS still wants their self-employment tax money or payroll tax money. And so they do require you to pay yourself a reasonable salary. A reasonable salary is based upon fair market rates for what you are doing in your business. So if you're the president and owner of your company, then you're probably going to be pulling down a pretty substantial salary. but you want to make sure that you get salary comps and different things to make sure that you're paying yourself a correct wage, or work with a tax strategist who can help you determine what that wage will be for your industry and for your role in your business. You'll pay payroll taxes on the salary that you receive. Just like the C corporation, these payroll taxes are deductible at the business level, so you get a write-off for those. And then any additional profits beyond your salary can be distributed as dividends. However, these aren't double tax dividends like you have in the C corporation. These are taxed at a lower rate since they're not subject to payroll taxes. Um, so which is really, really neat, because you take out those profits, you're not paying the double taxation that you are with the C corporation on those dividends, right? And so that's super, super important and a huge benefit of the S corporation. Now, the last entity I want to talk about today is the partnership. You know, partnerships are very similar to sole proprietorships. You take money out of that business via owner draws. That's a transfer from your business account to your personal account. Um, and, you don't have to pay yourself a salary, because those wages that you receive, or that money that you receive, is taxed with self-employment tax. Um, and therefore you are paying payroll taxes at the personal level. Um, and it doesn't matter if you actually withdraw the profits or not. Everything that you earn in a partnership is taxed with self-employment income. Now, you might be saying, Jeff, well, I have a partnership set up for real estate business and things like that. Okay, so if it's rental income, then you're not going to pay that self-employment tax or payroll tax on that money. But you would still be able to take that money out of the business via the online transfers or writing yourself a check. So it's important that you consult with your tax strategist on which entity you should be and how you get that money out of your business. With the S corporations, you have to pay yourself that reasonable salary. That's a very, very key point. The only time I've seen an S corporation audited is when the owners were paying themselves a reasonable salary. They were taking, four or $500,000 of distributions and no salary, and they did that for 20 years until we advised them, "Hey, you can't do this." Well, they got audited from their prior tax preparer, and the IRS went back 2 years and assessed penalties and interest on a reasonable payroll. Now, the IRS wanted to tax them on a payroll of about $120,000, but we were able to go out in the marketplace, pull comps, and only have them taxed on about $72,000. We saved them a ton of money, and we kept them from looking into the other years where they didn't pay any payroll taxes as well. So it's super important that you follow the rules and get the right advice. If you know a business owner out there, please like, share, and subscribe. This may help them out and keep them out of the tax trap, and help them keep more of their hard-earned money. Because you know what? I don't think the government spends your hard-earned money better than you do. So what I'm going to do for you guys today is I'm going to put a link down below for a free tax playbook. Please subscribe to that course. You'll get some great information and some additional tax write-offs. And I can't wait to jump in next week on some more tax tips. Thanks so much.